Amazing. Well, thank you everyone for joining today. We're super excited to take a look at kind of the opportunity set within climate tech, to have all of you here and to actually analyze some of this with the experts that you see on the screen. I think climate tech can be one of the more controversial topics today, and so we want to kind of put pieces of the puzzle together. But before I dive in, I just want to take a quick moment to acknowledge who Antler is and why we're focusing on this topic and where we actually want to go with this discussion. So Antler is a global stage VC. We work super closely with founders across industries from day zero, so both with solo founders, pre-established co-founding teams. So whether you have a company incorporated or you're still validating an idea, maybe climate tech, we would really love to hear from you. And our team works very closely with founders to get them funded, first by Antler and then quickly by other top European VCs, two of whom are on the call today. So we have Anu and we have Pale Blue Dot. And as part of this work, Antler's mission is really to improve the world by investing in the defining companies of the next decades. And that's really why we created this event, because climate tech, which has been, I think, near and dear to the investment theses of many impact funds to date, is really a sector that's moving into the scope and the purview of traditional VCs like Antler. And so as themes of energy prices, policy like the Climate Tech Inflation Act last week in the US, kind of shift consumer behaviors, we're really seeing real pressure on innovators to actually push this transition through. And so our goal is to help stimulate founders to build more and more in this space where we think massively important products have already been built, but should continue to be built. And I think selfishly, we also want to get smarter ourselves, pair up with thought leaders like Hampus and Melina, David and Lucky to kind of get into the nitty gritty of opportunities forthcoming. And so that said, in navigating climate as a traditional VC, I think we, among others, have faced some pretty tough questions. Things like whether climate tech should be monetized by profitable investors, or whether a green premium is a bottleneck to growth. We're also curious about deep tech investments. And so, David, I know we'll hear from you, but whether they do or don't fit into traditional VC cycles. And I would say, lastly, we're aware of the climate tech bubbles of the past. And part of where we think we should be discussing, and we're curious, is to know if you guys think we're entering another climate tech bubble or not. So to answer some of these, I'll say intentionally controversial topics, we'd really love to get input from all angles. And so we've actually quite carefully curated the panelists that you see today on this screen. And so we have Hampus Jacobson from Pale Blue Dot. Hampus, excited to hear from you because of a lot of your investment expertise in the climate, especially software space, but also I think you've been quite a pioneer in this space and longstanding champion here. Lucky Ahmed from Climate X for his point of view as the CEO of a quite massively growing climate tech software startup. And we have Melina Sanchez from Anu. Melina, specifically curious about your deep tech climate investing expertise, but also, you wear the hat of kind of the VP of Impact for Anu, so that perspective will be great. And then last but not least, David Audsanji from Voltfang. And David, for your input on what it really takes to run a deep tech startup in today's market. So what I'm going to do is pose these 4 questions to our panelists. We'll host a bit of debate, hopefully. And at the end, we'll leave time for a 10-minute Q&A. So please do drop your questions into the Q&A box as we go, and we'll tackle them at the end. So just before we kickstart the questions, I'd love to give the panelists a minute to introduce themselves, and I'll kick us off. So I'm Trisha. I am an associate working at Antler in Amsterdam, focused on impact investing and kind of championing that space. Hampus, I'll pass it to you, followed by Lucky, Melina, and David to give just a quick introduction.
Yeah, super brief. So Pale.dot, we're an 87 million euro fund investing in super early stage in climate. So far, we've done 22 investments, US and Europe, and we've done a bunch. I think it's 3 within hardware and nasty moving parts. We've done 1 or 2 which have stuff like synthetic biology or other extreme deep tech elements, and then we've done a bunch in finance, which I would say I swore when we started this fund that we were the least finance savvy fund you'll ever meet. And then we met Lucky. So, ta-da. So like, I think we've realized that, as we said when we started, that climate touches everything. And we originally thought that we were going to be more doing software because that's where the 3 of us, Heidi, Yul, and myself, come from, having built software startups. But we realized that 80% of all the skills are, of course, building teams and managing stuff and emotions and stuff like that. So that's where we spend all our time.
Hey everyone, so my name is Lucky. I'm co-founder of Climate X. Before this, I spent 10 years at HSBC in risk management, and then 5 years at Accenture consulting for my sins. And then a couple of years ago, just seeing what was happening with climate change globally, just, things were literally being destroyed around us, wildfires, for example, in California. And it started to raise a question in my mind, why is it that a property that might not have been affected by climate-related extreme weather events in the past, if it was going to be affected going forward because of flooding or fires, how does that affect the value of an asset? And when that happens and the asset's devalued, what does that mean for the financial system at large? And so that became an economic question, which we've now started to understand quite deeply. So things like, what does climate change look like in the future in terms of these macro level events? How do we connect that to extreme weather events right down to the local level? And how do those extreme weather events then affect the world around us when it comes to the way that we finance and value assets and manage our infrastructure and people? And that allows us to then start to think about adaptation. So it's a different side of the fence versus what I think people are traditionally used to hearing, which is around mitigation and carbon emissions and management. We're looking at the risk that's attached to climate change and trying to build a more resilient future.
Right. Hi, everyone. My name is Melina. I'm part of ANU. We are a 100 million euro evergreen impact fund based in Berlin, but investing in the US and Europe primarily. Around 80% of our portfolio is climate. I would define us as climate generalists. We invest in hardware, software, food, carbon removal, energy topics, and much more. A little bit about myself. I cover food and ag at ANU. But I also, as Trisha mentioned before, I am the VP of Impact, so I had to build the impact strategy for our organization, decide which sectors and segments we wanted to invest in based on our impact guidelines and impact analysis.
Hey everyone, I'm David, one of the co-founders of Force Fund. And as the West realized that we cannot rely on autocratic countries for our energy supply, we need to rely more on renewable energies. And for renewable energies, to make them accessible all the time, we need a lot of storage systems. And that's what we do. We offer a sustainable storage system. And maybe you ask why sustainable? Because we reuse EV batteries, like from a Tesla after the end of life. They reach after 10 years, they reach end of life. We get these batteries, we test them with our hardware test, and then we offer like an alternative to new produced batteries. And that's what we do. We contribute to the circular economy of the e-mobility and also support the energy transition.
Perfect. Thanks, guys. And I think just hearing your backgrounds really shows, as part of this energy transition, there are roles for basically everyone. And it's really great for us to kind of meet your impact communities and to also bring together your perspectives with a more traditional VC and startup lens. So I think can really shape the future of this together. And so let's start with question 1, which is whether climate tech should be monetized by traditional channels, as the massive growth and profit objectives can sometimes conflict with non-financial goals. And actually, David, I would love to start with you from kind of a startup perspective, particularly in hardware where you need more capital and for longer. What's your opinion as to who has the responsibility to fund impact companies and then who should earn from them?
Sure, I would love to answer this question. So in my opinion, it's really good that money is invested in climate tech, and more money should be invested because we face a lot of challenges in the future, and therefore we need a lot of money for it. Therefore, every VC should have an impact eye. And in my opinion, it's really good that we invest a lot of it in it, but we need one condition. The impact should be first. That's really important. So we need to see, okay, a company or a startup does an impact, and then we need to see, okay, it can deliver, like it makes profit and can grow by itself. But because when we don't make profit as a startup, we are a charity, and that's not sustainable also for our economy, because we need an economic shift, we need a systematic shift, and therefore we need companies who make an impact first and then also be profitable and grow by themselves. And if we grow, and as we grow, we can make more impact. That's really important. Therefore, I think we need the one condition of impactfulness in a good startup, and then we need to see, okay, the financials are also really good.
And David, do you think those come hand in hand, the profits and the impact, or is it sort of a staggered effect?
I think it comes hand in hand because in the future, we are going to have a lot of customers for climate tech, because the biggest customer is the world, and therefore it needs a lot of climate tech, and that's going to be like, okay, we need to pay for climate tech, and therefore will have profits. But right now, we also need like the government to support us to make this profit in the future like accessible. But I think it's going to be hand in hand, yeah, for sure.
Yeah, I think it's an interesting perspective. And I actually also wanted to ask Hampus, given your role as kind of a longstanding impact VC and having seen the need for capital here, what are your thoughts on whether all VCs should play in this space? And if they do, like how you would think about measuring growth, if it's based on an impact metric as opposed to profit?
No, exactly. I would say, like, first of all, I think that I don't like the word should. I think that especially within like a structure like capitalistic structure is really hard, because just like I think venture funds or anything, that they're probably investing because they want or get a profit, right? So it's hard to demand every single venture fund to realize that there would be great opportunities to invest in. I think they have to realize that on their own. But I think the thing I think about with climate, I think there are three different buckets. There's injustice, there's infrastructure, and there's innovation. So in injustice, it's just like we have a big problem that a lot of global north create a lot of the problem and are happily colonizing global south and don't care about wreaking the havoc. We're essentially recreating like the East India Company again and again. That is really, really hard to fix with a venture capital or even capitalistic lens. It's really hard to figure out. As just as any injustice, like most injustices, it's like if you figure out a business model, you're probably going to do something really evil about that. So in that, I have a very hard time seeing how capitalism works, period. Like, I really can't see that. Number two, infrastructure. Certain things in infrastructure we know like are tricky to monetize in a good way. And well, visit the US and you see adopt the highway signs. So suddenly you realize, okay, so somebody figured it out, right? So I think some of these in infrastructure, there are capitalistic models, but they might give you, I don't know, 2 to 5% interest rates over 20 years, which are amazing for certain vehicles, really, really bad for venture. So I think that I would say some of these, they're going to work. Infrastructure is amazing, right? The last one, innovation, that's in a sector where venture capital plays at their best. So I would say that it really depends on the idea. If you're looking to come up with a new idea of building bridges with a slightly different blend of cement, and you want a financing of like fixing all the bridges in the UK, I'm not sure where the venture capitalist would be. Innovating in the cement material, maybe. Actually deploying all the cement and building all the bridges, probably not venture, right? Maybe private equity, maybe public, but I think that that's the thing. So I think that's my answer to it. I think that climate is not like one size fits all. I think we have to slice and dice it. But I would say, I think getting back to David as well, I think it's super important that we have to realize that we can't just behave and say, oh, they're going to make a profit and they're going to slowly chip away from the purpose of this company and just certainly turn it into like a greenwashing company, because then we have completely failed.
Mm. Yeah, it's interesting. And I think it boils down as well to the definition of what impact is, and if at some point every product has some layer of impact. And Lucky, you can probably guess I'm coming your way, because I know a lot of what Climate X is focused on is integrating the impact of the energy transition into the pricing and the kind of structure of systems. But I'm curious to get your perspective on whether you see those kind of converging down the line, and therefore maybe this is an opportunity for every type of investor.
Yeah, look, I think it is. And I would even go a step further and say, look, if you wind the clock forward 10, 15, 20, 30 years, what is climate tech? And there's a lot of people that would argue that, this is just all about sustainability. And by definition, if you want sustainability, then that is the way that businesses thrive and survive, and that's how they return shareholder value over time. So on our side, what we're doing actually is we're identifying risks related to climate change. So this is what happens if we continue as we are. This is the difference versus getting to net zero faster. And there's a delta that sits between those two numbers in terms of potential losses to the global economy. And so once you know what those numbers look like, it gives you the tools that you need to start investing and making different choices around the way that we manage our businesses. And fundamentally, what that means is for a business, acquiring our data has an ROI. So this isn't about we're just giving them data because it looks good and they can show the investors on some pretty slides that they care about climate change. There's actual tangible financial benefit that helps them to boost the resiliency of their businesses. And I think this is what we need globally. And it's going to be what happens for everybody everywhere, whatever industry you're involved in. So I just don't think that climate tech is not an addition, or it's not a separate thing that's coming in. I think it's substituting what's already out there in more sustainable ways of working. And the more that happens, the more quickly it happens, and the better. But we should be charging for that, because it's not a charge. Now, what I do think needs to happen because the question with this comes down to actually, can people in certain developing nations afford to access these types of technologies? And that's where you got the problem, because if I monetize and charge and try and sell this data into parts of Africa, for example, where I know people need to understand how climate change is going to affect them, they won't be able to afford the data at the same prices that we might charge in other parts of the world. But secondly, and I think more importantly, is they've got problems today. Like, climate change is not the thing that's at the top of the list of concerns when they're trying to get COVID vaccines still, or there's war and conflict and various other things happening. And so sometimes we need to separate, I think, the monetization question from just, is it an issue that we as companies need to solve, or venture, or whomever, or is this government level funding that needs to go into these countries to help and support them to transition as well? Either way, somebody's going to be paying the bill for it. The question is, how do you go about doing that in the most efficient way? And on our side, I think we've got aspirations that in the future, what we'll do, hopefully, is as we build a profitable business, it means that we can give more back anyway as part of that, but it needs to be sustainable in the journey. But I don't see a separation. I don't even think climate tech will be a separate category in the future. I just think it's just going to be integrated into everything.
Mm-hmm.
We don't separate web and mobile now anymore, right? There used to be a time where we said like web technologies and mobile technologies. That would be a joke now.
Yeah.
Yeah, and I think what sometimes this boils down to is actually like risk. And I wanted to ask Melina, you, because I know your fund is evergreen, you invest in both software and hardware. Do you feel like you're taking on additional risk by playing in the climate space? And further to that point, do you feel like anyone can manage this risk, or does it take a really unique set of skills on the impact VC side to identify some of these risks and kind of protect yourself?
Yeah, I don't think that we are taking additional risk, in that a lot of investors that invested in climate tech, say 30 years ago, which was more catalytic at that point, did take those risks and did fail to provide returns to their shareholders. I think that the climate tech ecosystem has matured enough. It is true that there are certain technologies, so deep tech, carbon removal, that the technology for which the technology readiness is still quite low, and therefore you need to incorporate that risk into your investment evaluation decision making, along with the impact risk of this technology sometimes being a 1 or 0 game, whether it works or doesn't work as they try to scale. But that's already integrated, I would say, in how climate VCs are making these decisions. In terms of how to manage the risk more generally, so impact risk, it's very interesting because, as someone who has to create an impact strategy, the processes through which we evaluate startups, you would think that methodologies are very similar from fund to fund, and in reality, impact is, and climate generally sometimes can be defined in various ways, and the type of impact that I might be looking for might be different from the type of impact that another VC is looking for, or the guidelines around it. And so it happens quite often that I would say this is something that a climate technology we would invest in, and another fund, a peer fund, would say actually no, or the other way around. And I think that that fits a little bit into how VCs also manage risk, but I think there is a little bit more of a common understanding given also new regulation around SFDR and how funds will have to collect very similar data, which I still think is quite broad and doesn't really offer a full picture of the real risks that startups are facing on a regular basis. And so on the risk side, I think that there is some more common understanding, and yes, there are people who in VCs who are dedicated to that, but I don't think it has to be necessarily a separate position. It can be integrated in the day-to-day work of any investor in every decision-making process that they have. But on the impact side, so outside of risk, rather on the opportunity side, I think there is still a lot of differences from VC to VC.
Thanks, guys. And so I think I'll pivot us to the next question here, which really hits on green premiums. And just a quick definition, green premium is the additional cost of choosing a clean technology over one that emits a greater amount of greenhouse gases. And so the question here is whether this is actually a bottleneck to the further development and scaling of these products, and also whether that changes over time. And Lucky, I'm going to start with you because I know Climate X plays a role here in pricing this in, but what do green premiums mean to you? And who's actually buying this kind of pricing information today?
I think a lot of people are interested in green, brown premiums and how that balance is going to shift over time. So I think as these technologies scale, you'll find that the inverse is true, where actually I think renewable energies now is less costly than traditional forms of carbon intensive energies like coal and oil, right? So what we're going to see inevitably is that the more we can fuel and scale these greener technologies, the cheaper the cost will be, or the more cost effective they become, and therefore they become more accessible over time. And in fact, from a government policy point of view, the opposite is happening, where a lot of brown premiums are where the premiums in reality lie because of taxation. And so if you look at the carbon, sort of the pathways going forward, the socio-economic pathways that we're expecting, carbon pricing is going to accelerate as a deterrent from utilizing and investing in assets and buildings and companies that might be unsustainable in terms of the way that they practice. And we're already seeing that across the financial sector, for example, where the ratings of companies are being downgraded to recognize the fact that they don't perform well when it comes to the scope 1, 2, 3 emissions, or we just don't know because they don't disclose any information. So my gut feel is that this will just simply not be true as a statement in the coming years. And in fact, the opposite will, and it's already happening, in fact. So, and to be honest, like even from a green premium point of view, people are willing to pay for things that they have more of an attachment towards anyway. So if you think about good quality stuff, you'll be willing to pay for that. And there's a social conscience now that exists across consumers. That means that they want better things and they're happy to pay a premium if that means, you know, they feel good about the choices.
Yeah, and Lucky, I'm curious, just to double click, you mentioned financial services, but are there specific sectors you think today which face a green premium, which will change for them in the future?
Energy, I mean, energy is one of them, and energy is complex. If you look at logistics, for example, so, you know, we have conversations with huge shipping and logistics companies, and they've got huge challenges around these ships that they need to move cargo around the world with. That's expensive, and they need to transform the industry, and there's not many of them that really are big players in that space. And so they'll have to invest a lot of money to green their operations. And it's complex, and there's not many people because you don't have as much investment in hardware technology, and it's not accelerating as quickly to help them solve their challenges. So there are very specific manufacturing is another one, because they're tied to these types of processes which are, you know, by nature intensive in terms of water consumption. And so you see this all over the place. But I think those are the core industries that we rely on day to day. I think those are the ones that can be fundamentally affected.
Mm-hmm. Thanks. And I think, David, interesting to hear from you too, because you've built kind of a hardware impact battery solution. You compete with traditional batteries. How do you think about those price hurdles that come with kind of selling that impact product?
Sure. So it's really a good question, because we often face like the customer who ask us, you have second life batteries. Why aren't they like the half of the price? And then we need to argue, okay, we want to produce locally, we want to build like a net zero factory where nothing of energy comes up from outside, where we produce everything and use everything. And these things they are more cost effective, and therefore we don't want to produce in China and ship it here. We want to produce everything here and build it here and make it transparent for everybody. And therefore we are not the half of the price of a new battery, that's for sure. But in the end, I think that we should punish more like the not green, like not sustainable products. We shouldn't choose between something which is harm for the environment or the world or something which is sustainable. That's not the choice that a human should make. And therefore, we need to punish more like these things which harm the world. And then there's not a green premium anymore, because we will be cheaper. Also, the CO2 prices, which will skyrocket in the future. These are also things which make green more attractive. And that's where we should go. We need to go the path where unsustainability is not attractive anymore, and that's something many things should rely on, because we need to invest more, we need to punish other things, and we need to have more companies which are doing things like this and scale faster, because in scaling we also reduce the price. That's also for sure.
Mm-hmm.
Can I just make a point on that though? Because I think this idea of because like this idea and concept of increasing the pricing of everything else right now, like that's just not realistically going to happen. And I think you have to work with businesses to manage this transition in an effective way. People will always be cost sensitive when it comes to the decisions that they make. And so if in the real world you want to achieve this level of change, you have to drive the price down of the alternative. So either make it equal or lower than what it is the alternative option. You're seeing it around the world, right? Most people can't afford these things. And even when it comes to quality of food and basics, they go for the thing that's the cheapest en masse. So I would say that that almost should be the first thing. That means that the other things become less relevant, there's less demand, and it should drop. Then you start implementing the taxes to say, get these things out of the economy because they don't belong there. But the timing is going to be important, right?
But the thing there, which is nuts, is like we often neglect to look at how much money we're actually subsidizing extremely destructive technologies. So that's really the wild thing. It's like we're spending an immense amount of money subsidizing, of course, fossil fuels, as we know, but also animal handling, right? And it's completely crazy if you think about that. And I think that kind of what Bitcoin did to the world, where now you can say fiat currency and people don't think fiat is a car anymore. I think the thing is that we have the same with climate, is when people stare into the bubble of climate or the world of the vortex of climate, they actually start looking at the old economy and realize like, what the fuck, how much money are we spending to destroy the planet every day? And we're really helping out. I mean, we're like, there's a big discussion in the climate world. Is like, should we have geoengineering? Well, humanity have created the best geoengineering vehicle ever, and it's called cows. And we love them, and we get many of them. And now we can't even talk about policies for real geoengineering, but we're happy to subsidize cows. So I think it's really crazy that we need to look on the existing destruction technology.
One thing maybe when I could add something, I'm also with you. We in Germany have a privileged economy. For example, we can pay more for like green premium or something, not over the world. But when we start in Germany, they're shown like in a solar branch that we subsidize like the solar energy, and therefore the price is reduced, and then we could make it all over the world, because we spent so much money in the innovation, we invested so heavily in it that everybody prices just fall, and then we could use it like everywhere else in the world where they don't have the money like we have in Germany. Therefore, I think when right now it's hard for us to compete with new batteries. We are low, in a lower range, but in the end we cannot scale as fast as them, and also like the producing costs in China are way lower, and that was the problem also with the solar energy. We had a really good like branch, and we had really good companies in Germany, but we shifted all over to China because it was cheaper, and therefore we need to find a way where we can hold the companies in like Europe and not somewhere else, and also like reduce the price. And that's, yeah, in my opinion, it's right now we need to like don't subsidize these things anymore. That's crazy, and also punish it a little bit more, like to make everything else more attractive.
Yeah, and to add to that, not just not subsidize harmful technologies or products, but also subsidize or invest more in grants or non-dilutive capital from governments into new technologies. And, you know, at least in food tech, you know, there are some countries like Singapore that are supporting a lot of startups, a lot of R&D, but we are very far from, you know, in Europe at least, and in many other countries to get to a level where this type of non-dilutive capital can help decrease the cost of certain technologies that are still quite new, right? So let's not forget that VC is part of the equation, but you know, governments have a big role to play, as well as other stakeholders that still invest or fund in catalytic impact.
Yeah,
one should remember that venture capital is like 2% of the world economy, or 1% or something. Like, it's nothing. It's absolutely nothing on the dot of financing.
Just one last point on this question, I guess, for both Melina and Hampus, but as investors, if a startup pitches you an idea, it's priced above a comparable product, what do you guys do to assess where it's going and to think about cost parity? Is there a technology? Is there a metric? Just a gut feeling? Anything come to mind?
Well, at least in food, you look at techno-economic analysis, depending on the stage of the startup, also depending on whether there are other startups that have proven a certain level of scalability already, or if it's a completely new technology. But definitely that's part of the decision-making process, because as we were saying before, we don't want to invest in a company or in a technology that will always have some sort of premium over, you know, the traditional cow or traditional meat, because then only a certain part of the population that is already privileged by definition will be able to access it, while the rest will have to, you know, pay the cost of, you know, carbon taxes or whatnot. And so it's definitely part of the due diligence of the investment decision-making process. And depending on the technology, you will look at certain data or certain, you know, academic research, or, you know, look or talk to experts in the field. It really depends.
Yeah. Okay, let's lead into question 3. And this is really about deep tech, or also could call hardware, but products based on high-tech innovation and engineering or significant scientific advancement. And so the question here is, you know, while there are so many opportunities for climate entrepreneurship in deep tech, the space is quite risky and hard to fit into traditional funding models. And I think back to the climate tech bubble, I believe it was like around 10 years back. And part of this was VCs not necessarily understanding the time horizons here needed to allow these startups to kind of grow and fulfill their opportunity. And so, Melina, I'd love to stick with you and get your perspective, especially with a newer fund like Enu. Like, how have you hired and staffed to properly set yourselves up for deep tech investing? And what does your time horizon look like to make that happen?
Yeah, so by definition, because we are an evergreen fund, we don't have a fixed time horizon, which I think is quite new in the industry. That being said, there are other VCs that are experimenting with other type of legal structures. So instead of having a 10-year time horizon, you might have a 20-year time horizon, which might be a better fit for hardware and deep tech technologies that necessitate a longer R&D time frame. So in that sense, one of the reasons why we chose these evergreen fund is because climate is not something that we are going to solve in 5 years, in 3 years, or in 10 years. And constructing a portfolio of both hardware and software will require some flexibility, will require understanding the time horizons of different technologies differently, instead of having, you know, this average everywhere. And that's how we set ourselves up. And in terms of how we hire and we staff them, we have engineers in the team. We have people that have worked in renewable energy before, that understand also the complexities of these technologies and can help us understand what those time horizons might be. So we are not just a purely, you know, like software, you know, in previous investors that don't understand the complexities of these climate technologies.
And Hampus, what do you think here? Is your point of view the same? Do you think you need PhDs to evaluate these opportunities?
So I come from a family with a lot of PhDs. I would say that I think that PhD is a mindset, not a degree. And we have a full-time PhD who's a climate researcher. She's literally got a PhD in climatology. I think it's amazing to talk to Lindsay about stuff. I am also on a firm belief that whoever says they can predict the future are just wrong. So I think at the end of the day, I think we can fit a lot. I totally agree with Melina. Certain solutions are extremely hard. And I think that especially it's nice to not have to bother sometimes. I think especially if you're looking at solutions which are more infrastructure based, then it's really nice to think about that the actual value might actually accrue in maybe 10 or 15 years because of the long time of installation. But I would say most solutions are not that. I think that, I mean, I've invested in 150 plus companies over the years. I would say like fusion reactors, stem cell grown organs. It's just like some things that, like when we met the company, they said, we probably will have the first prototype in 2040. And we were all like, let's go do and invest $6 million. So I think that the thing is, I just don't believe that this is true. And I think the best use case I think we've seen is actually Lux Capital in the US. Lux Capital has like an amazing track record, both in the kind of crazy innovations they've created. I think with European view, I think a lot of Europeans, we view them as a very like militaristic kind of venture fund. They do a lot of like very kind of in that direction. But if you think about the innovations they do and the innovations they invest in are things that venture capital in Europe for the last up until the last 5 years maybe, would have never even talked about. And I think they're a completely normal structured venture fund. So I think this is not a real problem. I think a lot of venture capitalists hide behind stuff like, oh, we can't handle the timelines or we don't handle hardware. And what they're actually saying, I can't bother thinking about this. This is too complicated. I would really prefer to have a Caparini on top of the rooftop, and I don't want to think about this. I think it's total bullshit for a lot of VCs. It's not easier to predict user behaviors. It's way harder to figure out if people want to buy Korean cosmetics in Berlin than figure out how we actually build modular fission reactors. So I think it's a joke.
And Hampus, just tell us your perspective as well on early stage climate tech investing versus later. Anything there around the opportunity?
How do you mean, sorry?
Just, do you think there's because if you look at the flows and the deals, you've seen a lot in kind of pre-seed seed stage for climate tech. It also makes sense because we're at the beginning of this, I think, massive transition, but you are at an early stage VC. And do you feel like this is a bigger opportunity perhaps for you than perhaps a later stage?
Oh, no. I think later stage. No, I think that we're good friends with like Cotu, for example. I don't remember now. I think they did roughly 24, 30 deals the last 24 months. They deployed, I think that's a couple of $1 billion. They don't seem to have a headache at all. I think I know about their new fundraise where they're doing a blended of structured investments others of a couple multi-billion dollar. It's super clear. I think climate change is one of the biggest opportunities we've ever seen on the planet. It's because it's one of the biggest challenges. I think that, like web is a great thing, right? Like web was a great like infrastructural change. Web doesn't touch everything, but it touched probably like 80% of everything that happens on the planet. Well, climate touches probably 95, right? So I think climate is a way bigger thing than web. And I think if you meet an investor today that say they wouldn't invest in a web technology, I don't understand who they are. So I think every single investor would invest in climate. And as Lucky said, it's not going to be a theme. It's going to be like saying you're investing in web. So I think there are going to be opportunities in super early stages, in venture, in growth, in public markets. It's going to be all the way.
Yep.
And it is. People are deploying enormous amount of money in it, and I think on very sensible things.
Yeah. So before we move on, I just wanted to flip this and ask David and Lucky from the perspective of, impact startups. What do you want your VCs to know? Like what kind of skills, what kind of knowledge and expertise do you feel like they need? And maybe this is different between hardware and software, but maybe David, I'll start with you.
To be honest, our idea is not so hard to understand because in the end, we have a lot of EV batteries which are coming to the market and don't have a recycling capacity. And we need a lot of storage systems in the future. And therefore, it's a logical way that we need to have storage systems out of sync, which lying on the street. And therefore, in the end, it's easy to understand the logic. Okay, we need it in the future. And when we have enough motivated people and enough money, every product can be produced. It could be a fusion, it could be flying to the Mars. Everything can be done if there's enough people who believe in it and enough capital which believes in the idea, and if you can execute it, of course. But in the end, it's it's not so for the VCs, we hope that they understand what we need to, which challenges we need to face, and which is really important. The time, like the time we need for R&D, it's different software because we need to try something, it doesn't work, we need to try it again, and then we need to buy things from somewhere which have like delays, and things like this are not common in the software, but in the hardware they are like there every day, and therefore the R&D and also the cycles are longer, and that needs to be understood, and also like a bit of understanding of what we're really doing and what complexity come with it. This is really important for us to that the VCs know which challenges we are facing. That's
I love the low bar we're putting on investors here, that they know some of the challenges. I mean, I'm just laughing at it. I 100% agree with it. It's just so funny that that's the bar. It's like
it's hard because we are doing it for many years, and how should we expect from the investor to know these things which we are working on for 10 years, 20 years, or not me, but other entrepreneurs as well. But yeah, in the end, it should be logical, and they need to believe in us that we can execute it. And that's the only things we see that the VC needs to know.
Yeah, David, and I know you're a portfolio company of Anu, and I think something that resonated with me, you said in a prep call, was that VCs, really need to be patient here and see the long term, and especially with hardware. And I think that's common across the board. But when we think about building for the future, so much opportunity is in that hardware space that you just need more VCs to be more patient for longer.
Maybe one thing regarding to deep tech, I believe that software will not cure like everything, because there are many software startups which are really important, but there are also software startups or deliveries which deliver beer in 10 minutes. They are not important for the environment. In the end, the major problems will be solved by deep tech or hardware, because, for example, hardware stores energy, hardware captures CO2. These things need to be done, and therefore we need to invest like in this risky. I see more in a complex area of deep tech, because in the end, the difference between us and a 10 minutes delivery is that we build like a fundament. We have, in the end, we have a Second Life factory. We have a technique which we can scale, and this is also physical and not just a bet on a future. Who is the fastest delivery company? Therefore, I think it's risky, but not as risky as, for example, like these delivery companies.
Yeah.
Trisha, allow me, if you don't mind,
Yes.
giving an analogy on these cycles, because sometimes I compare enterprise, typical enterprise software to these R&D cycles of hard tech. Enterprise, usually you have very long sales cycles, and all of a sudden you have a big peak in revenue, and it comes in very big chunks, right? And so it's not like the traditional B2C software company that it's very exponential, very smooth curves. So it's similar in R&D hard tech, right? You work a lot on a specific part of that product development strategy for a long time, and all of a sudden you have cracked that, and then you move to the next step. And in food tech, I see that a lot, where, for example, in precision fermentation, you might be working with 10 little bioreactors for, 12 months, and then you crack that, you need to scale to 100 liters. And the probability of success in 100 liter might be a lot lower. And it has different type of risk return. So it's those very like spiky development cycles, similar to enterprise sales. And that's, I think, a useful analogy.
Yeah. So let's move just to the fourth final question. And Lucky, I'll start with you, but the question is really digging back to the climate tech bubble. And we touched on it briefly. 2012, I believe, and many climate tech companies, it did go kind of belly up. And the question is whether we're currently creating a similar bubble due to capital influx to climate funds, which will result in heavy losses. Lucky, what's your opinion?
I guess on my side with this one, look, it depends how you define a bubble. Eventually there's a recession that's going to come, because these things happen in waves. There's a pattern every decade or 12, 15 years. There will be a recession, markets recalibrate, and that's just the way of the world. And so people should be aware of that. And then what happens is people, when these things happen, start to go back to fundamentals. But the problem is that the fundamentals disappear over that time horizon as, you know, the market grows. People can be more reckless when it comes to the way that they manage their spending, the things that they invest in, the way that they value companies, and vice versa. And so you end up in a situation where I think all the conditions inevitably lead to these types of bubbles happening. And then there's a recalibration. Now, with climate tech, I guess the question is like, what would drive that in the first place, and what happened over the last couple of years? We saw that there was maybe too much capital going in, and from a founder perspective, a lot of people were prioritizing the wrong thing. It was about sell, get as much money as you can as quickly as possible, maybe achieve founder success, so the founder walks away with some money at the end of, you know, a couple of years, but the business goes bust. And that's okay for the founder because they walk away with something that justifies the time. Now, my thing is, and the way that we've been managing our business and our spend has been to be really diligent around the amount of money that we raise, valuation, because whenever we think about valuation of the company, I'm thinking about it as a hurdle for the next round that I'm going to probably have to raise. So how do I make sure that I don't raise the bar so high that now I need to pole vault above it as opposed to just skip above it? You know, that's creating exponential risk on my side. And so what we end up doing, and what we did on our last round, is actually something unusual, but we dropped the valuation versus what even the lead investors that we wanted had offered us, just so that we could prepare the business so that it had a better opportunity to survive. And there was nothing to do with the fact that we thought there's a recession coming. It was just the right thing to do because the VCs were comfortable with putting in high prices because they thought that's the most attractive thing for a founder to hear, is that we're going to help you retain all the equity and give you the value that we want. But I think in the end, you end up with bad decisions off the back of it. So now, for me, like these types of things, these recessions and these bubbles that we see when they burst, it's a good thing because these recalibrations need to happen. You can't have infinite amounts of capital flowing into companies. At the end of the day, one thing that I think a lot of people omit and don't look at is what happens later stage. Like when companies IPO, what type of companies do actually IPO and what are the valuations that they're achieving? When there's an M&A, what do those metrics actually look like? Are they happening at these types of multiples? No, is the answer. So who's actually benefiting off the back of it? And so if you are genuinely going out there to try and build a business in the first place, as a founder, I think you should take your responsibility and not do reckless things when it comes to decisions you make. Just because an investor said, do this and take this much money because it's on the table, why should you start bidding more? Why should you start pushing the price up and risking the business? And to me, it's just foolishness. But you know, we live in a world where the internet's there and people are, you know, you have all these gurus telling you what to do and how to do it, and Twitter threads that give you all the answers, and people think that that's life and that's business, but it's not. So I think that there will be booms and busts like forever. There always has been, there always will be. This time, the only positive thing, I guess, is because it's such a big problem and it's existential, it affects everything, everyone on this planet. There is definitely opportunity to win and to do great things. Just do it in a diligent way because, you know, we've got a race to go through, and there's sustainable changes we want to make. It's big infrastructure changes. It's going to take time. And so we should do it in a diligent way. And I think, and I hope that the investors will do the same thing now when it comes to deploying capital. And I can say, like, you know, if Hampus doesn't mind me saying it, it was never love at first sight where they came to, and that's why I think Pelbit been quite good. They didn't throw money at us. I think they said no to us like 3 or 4 times actually, before eventually they came on board and said, okay, they kind of get what we're doing, and they trusted that we knew our market. We saw a vision of the future based on tangible things like regulation and legislation that was inevitable, that was going to drive a market for our data, and just aside from that, there's a need. So, and I think more of that's needed, diligence and just understanding what is good.
Yeah, like
I would actually say one of the reasons we couldn't we ended up investing is because Heidi came out of the meeting room so many times saying, I can't decline them, Hampus, I can't decline them. And I said, I think you should invest given the fact that you can't decline them. And she was like, that's the worst or the best reason I've ever heard. So like, it was such a great meta conversation after a while.
But it's great to hear too, because I know we have a lot of potential Antler founders on the line, Lucky, and they're kind of beating their heads around like how to build a business in a space where we're kind of standing on moving ground, and you really have to keep pushing. And I actually wanted to point to some numbers here, because you can see, and this is just from Climate Tech VC, but in terms of dry powder that is available for investment, it's that top part here. You know, there's still a lot of room to run. And the question I have for maybe Hampus and Melina is, from your perspective, are there enough quality startups like Climate X and like Voltfang to put this dry powder to good, worthy cause and make lucrative VC investments?
I can go. I mean, definitely with the market dynamics, everyone is being extra careful about flying to quality and making sure that you're not deploying the capital that you have, fast and sometimes dirty. And so thinking about quality has been our priority over the last few months. And I do think that there are enough startups that are high quality within climate. Indeed, if you look at the different sectors and which ones have gotten within climate more or less capital over time, we are overinvested in mobility, we are underinvested in food, we are underinvested in buildings and infrastructure. And so I think that there are opportunities for investors to even look at certain sectors that have been under the radar and find those very high quality startups there. And that's what we are doing as well at the moment. So definitely enough quality.
Yeah, I would say 100% agree. I think that there's immense amount. I think that we're looking at things all the time, and we're always feeling anxious that we're investing too slow and too fast. And I think we've done it since we started the fund. I think we've been a fairly even pace of roughly one investment per month. So I think I don't think it's a big difference. I also think that one thing to put in perspective, that one of the reasons we had the clean tech bubble is that venture capital actually invested in commodities, which is absolutely not venture capital compliant. So I think I really think it's important that people realize that the clean tech bubble was not, and 90% of it was driven by people investing in stuff that has no overlap with climate tech. And the funny thing is, some of the funds that actually were amazing, they invested in stuff like, for example, Nest, and the Nest would have, I think, passed the test of being a climate tech company today, whereas the companies who essentially try to sell and buy sand is like, it's a very tricky business in any kind of landscape. So I feel like it's a massive fear of that we have a climate bubble. But the thing is that, we have, as David said it, as Melina said it, we have a massive kind of quick commerce bubble, or yet another scooter company bubble. But nobody kind of, few people point at that as an individual bubble. But the bubble, I think climate tech is so broad. And I think that we see amazing quality. We're not changing our view on continuing investing. And the funny thing is, when we're talking to LPs, the ones that are investors in funds, they don't see that either. So we have a lot of people who are asking us about when we're building fund 2, and if we're going to make it, how much larger we're going to make it, because they really want to see more investments going into it. And of course, many of our LPs are people who are just looking at pure investments. They're coming from pension funds, and for them, it's really important, of course, for being able to hand out pension money in 40 years.
Awesome, guys. Well, Hampus, we can't wait for the next fund. Let's just do a quick Q&A. I think we have 5 minutes left. And thank you all for your comments. I think very insightful. So the first one here is from Vanya. And the question is, we're talking about technology and company risk, but how do you guys think about policy risk? And she says, until companies are forced to internalize negative externalities through regulation, do you think that this market can actually reach maturity?
Can I maybe comment on that? Like, we stay abreast of all this regulation. It's just what we do. There's so much regulation out there, you wouldn't believe how much consultation there is happening every single day across every country in the world, pretty much. And it's not publicized because it's not sexy. In fact, it's monotonous even for me to read it all, but we have to, because we have to think about how do we package our data to service those needs. So governments globally are moving, and they're forcing change in different ways. So one is this legislation that directly affects corporates and the way that they do business and the things that they disclose. So TCFD is the Task Force for Climate Financial Disclosures. These are being mandated for large and listed companies around the world globally. Like, it's happening. It's already legislation in the UK, in Japan, in the US. There's a landmark bill that was passed over the weekend, which shows finally some signals and signs of action and investment. I think it's like 1.8% of GDP towards climate related issues. So there's already things happening on the direct side. The other side is the financing. So the reason these oil and gas companies continue to exist is because the likes of HSBC are funding these businesses and allowing them to to do what they do. Pension funds are investing your money into these types of companies over the long run to give you returns. And so there's a lot of changes happening in this space now. So financial regulators globally, there's 116 central banks around the world that are also forcing climate-related stress tests and disclosures for the first time. And it's happened in the UK already, the first steps of that. It's happening across Europe. I think there was an exercise last year, and across APAC, and hopefully now the US is going to start to move as well. And even China, believe it or not, are doing the same types of things because they see a threat to the economy. So regulation is already happening. The next step is, how do you understand whether there's greenwashing or these types of issues? So there are task forces now globally that are also being implemented to implement controls that prevent misstatements and misleading statements around the state of climate-related risks in companies, because that affects the economy. So I think it's already happening. It's just a case of people are moving diligently and with the steps to try and give the right levels of guidance. It's really complex, but we should see change, and it's inevitable.
Thanks, Lucky. One more question here, which is, in such a broad space as climate tech, how do you decide whether startups have a big enough impact? And some startups' impact can be quantified in terms of CO2, GHG, others tackle biodiversity, water use. It might be harder to quantify. How do you think about those?
Yeah, that's what I was mentioning at the beginning of the conversation, that different VCs have different definitions of impact and different ways to operationalize that impact. And in our case, we decided to have a very holistic view on impact and climate, and not just look at GHG emissions, even if it's one of our primary goals, but also look at water and biodiversity. And there are definitely KPIs that you can measure against these specific goals, whether it's, for example, PhD of a pH of water or land restored. So it really depends on the startup and what they are doing. I tried also to caution that quantifying impact is important, but it should not be the end goal, right? Impact is a way to really manage the risks that we are facing and to contribute, to solutions down the line. But measuring impact is just part of the process, is not the end goal. And therefore, when a lot of VCs, and we have that pressure also because of regulation, because of LPs, it's all about, oh, hey, what's your KPI? What's your KPI? What's the number from last quarter? That's part of the conversation, but we should be also looking at ESG. We should be looking at what are those impacts that we are not even thinking about, what are those impacts that are not quantifiable, as Pascal mentioned here, and integrate that into decision-making process about follow-on investments, for example, or exit opportunities, etc. And so it's a conversation that one could talk about for hours and hours, but at least the bottom line for me is that there's no one definition of impact. Not every VC has to have the same goals and the same KPIs. We should move beyond just measuring and really managing impact.
Thanks, Melina. I think we're just at time here, and I wanted to just close by saying thank you so much to the panelists and for being honest and sharing your insights on these topics. If anyone on the line is interested in climate tech founders or people looking to start companies, especially in pre-seed phases, please do reach out to Antler. Contact information is here, but we'd love to hear from you. We'd love to learn from you, with you, and kind of bounce ideas off with our friends in the space. So very much appreciate it. And thanks, everyone.
Thank you.
Thank you.
Thanks.